Hello, everyone, and thank you for joining us during the Lytham Partners Fall 2023 Investor Select Conference. My name is Roger Weiss, and I'm a Vice President of Lytham Partners. In this presentation, we welcome Aytu BioPharma, NASDAQ ticker symbol AYTU. And today we have with us Chief Executive Officer Josh Disbrow. Before we begin, I want to remind everybody that management is available for one-on-one meetings later this week. If you've not already signed up, please send me an email at weiss@lythampartners.com or visit www.lythampartners.com/virtual and click the one-on-one meeting request button. All right, Josh, let's begin. Could you please introduce yourself and give us a brief overview of Aytu?
Sure, happy to, Roger. Thanks for having us at the Lytham conference, and glad to be with you. And my name is Josh Disbrow. I'm the Chief Executive Officer and one of the co-founders of Aytu BioPharma. The company started about 8 years ago, and we've grown substantially, primarily through a series of strategic transactions. We're focused on commercializing prescription products, and we'll get into some of the details around that. My background is 25 years plus in the pharmaceutical industry, from sales all the way through management at the executive ranks, inclusive of having built a specialty pharmaceutical company from scratch with my co-founder, Jared Disbrow, and exiting that at over $1 billion in valuation to a large private equity group. And so we started Aytu as a bit of an homage to that company that we built very successfully, and we're on our way, and we're excited to continue our growth here as Aytu. So glad to be with you.
Very good. You know, this past year, Aytu announced a change in its game plan from what I'll call a triple play of spec pharma, OTC consumer health, and drug development to focus solely on its specialty pharma prescription business. Can you review the circumstances that were the catalyst for this evolution and, talk about how the company is currently positioned?
Yeah, sure. Last year, about this time, we made the decision to really squarely focus on the commercial side of our business. We had before that really done a full strategic review and looked at where we were. As you mentioned, we were a bit of a triple play. We were in R&D, developing a rare disease asset. We were in consumer and prescription, what we call our RX segment. And we were pretty deep still in manufacturing, having acquired a manufacturing facility as part of acquiring the ADHD brand. So we were a diverse company with a lot going on and, frankly, a lot of burn. A year ago, plus, you would look at a company that was burning in excess of $20 million. And most of that burn, as you really evaluate it, was on everything except for the RX segment. And so we began the process and made the first hard decision, which was to really wind down research and development for our pipeline assets. And in the case of two of those assets, returned them to their licensors or owners, one of which we've maintained, but have essentially turned the lights off indefinitely. And so that has served to really free up a lot of cash and enable us to focus specifically on the prescription business. And look, it's no surprise to anyone that's attending the conference or paying attention to the markets at large, whether you're talking about pharmaceuticals, biotechnology, whether you're talking about pharma services. The bottom line is the sector has been challenged from a capital markets perspective. Access to capital has really become more limited. And so we think, the very smart decision of focusing on the parts of our business that drive revenue, drive EBITDA, and we expect to soon be driving net income and cash flow. And so we stopped all the things that are burning and focused really, and particularly when you fast forward to kind of where we are today, focusing squarely on the prescription segment, which is EBITDA positive, does have a very clear path to profitability and cash flow. And so step one, of course, again, was shutting down the R&D pipeline. Step two was focusing on the parts of our business that can cash flow. And so that led us to, here fairly recently, to begin the wind down of the consumer health segment, which, while it was a segment that was generating meaningful revenue for the company, has not yet generated a profit, nor has it generated a positive EBITDA in the last several years. And so we've just got to stop the burn. And we think what really makes the most sense is to drive what's going to drive the most value for shareholders and really ultimately yield in the most successful company in the long term, which is to focus on the prescription segment. So where we're positioned today is if you were to look at the RX segment, particularly if you were to look at, say, the last 12 months that we reported out a couple of weeks ago, looking at our fiscal 23 year end, which ended June 30th of this year, you're looking at a company that was EBITDA positive. The sector, specifically the RX segment, was EBITDA positive, quite handsomely so, and exited the year in the fourth quarter at about a 35% EBITDA margin, highest revenues in that segment's history, strong growth, a lot of wind in our sails. And so really that's what we've gone all in on here over the last several quarters, and as we look at the company going forward.
Got it. Picking up on that fourth quarter number that you reported, the RX business generated almost 75 million in revenues for the year. You showed in the fourth quarter extremely strong script growth. I think it was something like 32%. And how do you think about that growth as now we're significantly into the fiscal year 2024 for you? You know, where does that script growth take you? How do you think about revenues, about adjusted EBITDA, and you know, what drives continuing sales growth for the company?
We do certainly expect continuing growth on the whole. Now, we are subjected to seasonal variability and really across our portfolio, whether it's the ADHD portfolio or the pediatric portfolio. But as I look out to fiscal 24, fiscal 25 and beyond, we expect continued growth. We expect to, and again, we are going to squarely focus on the prescription segment, which, as you said, has experienced extremely strong growth from both a prescription standpoint, and that is, of course, carried through to revenue growth across the portfolio of ADHD and pediatrics. The growth is being driven, you know, by multiple factors. Some of it is organic growth and just excellent execution. Some of it is through the leverage we've gained through our RX Connect platform, which we expect to continue to gain. Some is through some of the market factors, which I'm sure we'll discuss. Most notably, some of the market factors affecting the ADHD market. And so we expect to see top line growth across the board. And that is not to say we expect growth from last quarter to this quarter and the next quarter. Again, there are seasonal factors that affect our business. We bake that into how we sort of manage expenses and manage our gross to nets. And so we're very excited as we look out to the fiscal 24 sort of promise and beyond. We are squarely focused on EBITDA growth, though, because we do, with the wind down of the consumer health segment, that's a segment that generated $33+ million last year. We will essentially turn that off because we don't believe that generating revenue for the sake of revenue at this stage makes sense. We would rather focus on revenue that drives EBITDA and profitability. The RX segment does that. So the RX segment will grow. Fully expect that and expect to see continued growth across the portfolio. The consumer segment will come down. So from a top line perspective, we may be more or less flat, but we do expect to see margin expansion and EBITDA positivity as we go forward. And that's going to, again, be largely driven on this square focus on the prescription segment. And it's, of course, being aided by multiple factors, as I've talked about, and as I'm sure we'll get into. So excited about being able to double down, squarely focus on the prescription business, because that's what's driving the growth. And that is what will drive the company to profitability.
Right. And clearly one of the drivers or the driver within the prescription segment is ADHD drugs. And when we were sitting here at this conference a year ago, one of the things that we spoke about was the dislocation in the market and people not being able to get their prescriptions filled, out of stocks, problems at Teva. And I think I never would have believed that a year later, we'd still be looking at issues in the marketplace. But in fact, here we are. So when we talk about ADHD stimulants, the amphetamines, methylphenidates, shortages of these two categories, could you talk about, you know, both in terms of hindsight, where we have been, what's driving the turmoil, what are the regulatory's role and response, and how are these shortages both, you know, impacting the market, and how are you guys, you know, helping out here?
Well, first of all, Roger, I'm happy to say that we are helping out in a big way. I mean, there is a significant gap in the stimulant category by virtue of multiple factors, which I'll get into. But, you know, what this is clearly impacting is patient care in ADHD. We have patients that are longstanding patients of, for example, Adderall XR, and all of a sudden, one day they try to get their prescription filled after having been on it day after day, month after month, year after year, and they can't access it. The pharmacist perhaps can't tell them even when they can get it because of this shortage that is persistent. And as you said, it started over a year ago and it continues in various shapes or forms. And it now affects not just the amphetamine world, which is the active pharmaceutical ingredient in Adderall and Adderall XR. It's now affecting methylphenidate, which is Concerta and its similar products. And so we've got the ability to help in both of those categories, both amphetamine and in methylphenidate, because we have been able to secure quota, which has been one of the issues that some of the larger companies have been delayed in getting. So quite simply, it started about a year ago. One of the largest manufacturers, Teva, reported labor issues. That sort of spiraled further out of control when they were sort of late to get the requisite quota in the face of increasing demand. And that does really that underpins a lot of this. I mean, the diagnosis rate for ADHD has gone up tremendously since the pandemic, with the advent of working from home, and with telehealth, and with patients experiencing just greater symptoms and realizing that they actually have ADHD. So you couple the rise in demand / diagnosis rate, coupled with sluggish response from the DEA in granting additional quota, coupled with large manufacturers that have had a labor issue, and it really has caused that to linger. People have asked, well, haven't those labor issues been resolved? To some degree, they have, but frankly, some of the large manufacturers have been mum on their ability to get product back online. So the problem it persists. It persists across the board. And then there's further compounding of the issue with, for example, in the case of the methylphenidate category, some manufacturers have just dropped out of the market altogether, perhaps for economic reasons, perhaps related to supply chain reasons. We don't entirely know. But the bottom line is our products, Adzenys XR ODT and our methylphenidate product, Cotempla XR ODT, have remained in supply, and we've been able to gain meaningful market share to help serve some of these patients in the face of this shortage. It is looking like it's going to continue. Very few of the manufacturers have been able to give a clear line of sight into when exactly they'll get back in stock. And look, the reality is once a patient switches from one product to another that they're satisfied with, they stay on it. This is a sticky category where once patients are satisfied, they stay on it. And we've heard that time and time again. Patients have switched from one product, for example, maybe generic Adderall XR, to our product, Adzenys. They do very well, responding extremely well. They like it, and they like not just the experience they're getting from a clinical perspective, they really like the experience they're getting from a customer service and support perspective through a program that we call RX Connect. And so once you demonstrate to a patient that there is a better alternative and there's something that is suitable for them clinically, and in many cases might even be a better choice for them clinically, and then they couple that with what we essentially guarantee as a copay that they'll pay no more than, in the case of our ADHD meds, $50 if it's commercially insured. Patients really like it. So we've been able to step in, serve a meaningful hole, but this hole is not transient. It doesn't close when Adderall gets back in stock, because those patients are on drug now. They're taking our product at Adzenys or Cotempla. They're liking it. They're getting a great experience. And again, clinically, they're happy. From a customer service, price, and availability perspective, they're happy. And that's really all by virtue of how we orient ourselves through our very innovative commercialization program called RX Connect.
Got it. A couple of times you mentioned the DEA and the supply of the raw materials. Obviously, you're taking the raw materials and turning them into drugs for the underlying patient. How do you manage that regulatory relationship with the DEA and making sure that you have enough raw material, especially when, as we just talked about, you're seeing 30% growth in scripts?
Yeah, so the DEA is a process where annually they set a quota, and they go to all the manufacturers and essentially pool the demand, and then they determine how much active pharmaceutical ingredient needs to be allocated to each manufacturer on the basis of the drugs that they manufacture. In our case, again, we manufacture both an amphetamine with Adzenys as well as a methylphenidate with Cotempla. But you're right, in the face of increasing demand, particularly when you see relatively substantial increases in demand, we have to be very responsive to that and go back to the DEA, and that's what we do in very real time. Certainly no less than monthly, we're interacting with the DEA to request additional quota. And I'm happy to say we've been consistent being able to secure additional quota. And it may not always be the exact amount that you request, but they've been enabling us to go in and do additional requests throughout the calendar year, really throughout this entire process since the shortage has started. And I'm happy to say We've been able to secure everything we need to get the increasing demand and continue to get additional requests into the DEA, and they've been responsive. Typically, it's within a few weeks you hear back, and you're providing them, of course, with all the relevant data to demonstrate that real demand exists. You're showing them the prescription data from the data providers. You're showing them real purchase orders and actual factory shipments to demonstrate that this is going to our end users and ultimately for the benefit of patients. And so we've been able to, by virtue of the fact that we're relatively small, secure the quota that we need. We obviously are a relatively small player, although growing, such that the quota request we have is materially smaller than what, for example, a Teva would request. And so if Teva gets shorted by 10%, that's a meaningful amount from just a sheer volume perspective. If we get shorted by 10%, we simply just have to go back and get an extra kilogram, for example, to sort of bridge that gap and be able to meet the demand that we're making. And to date, and really in the history of these products since their launch, have always been able to get that quota, even as these products have continued to grow. And so we have a lot more capacity, and we have the ability to manufacture as our demand continues to grow. And as we'll talk about, we've got plans to transition manufacturing to a large contract manufacturer that will be able to give us additional capacity, and then eventually we'll transition all manufacturing to them. So we're quite happy with our situation in that we're able to get the quota that we need. Sometimes you don't get everything you ask for, but again, eventually you get what you need to satisfy demand. And we've been able to do that again without any shortages in supply since these products have launched. So we're gobbling market share. We're getting new patients. They're getting this new experience. And it's really been a tremendous growth opportunity for the company as we've been able to step in and help these patients.
That's phenomenal. One of the other areas I know that you've been seeing very strong growth in has been in your pediatric vitamin products. And I think you've talked about launching an arcofolin product as part of that product line. Where do you think about arcofolins taking the brand's future growth? And how does this support your both, I guess, long-term strategies and goals for the multivitamin products?
Yeah, our multivitamin products are unique, and they've continued to grow very nicely, largely through just increasing awareness of the fact that many parts of the country, particularly in the tri-state area around New York, are not fluoridated. The municipalities have elected for various reasons to not put fluoride in the water supply, so you have to supplement. And so elevating the awareness in those communities through various activities that we're doing, not the least of which is through physician promotion, that has certainly driven demand for those products. And the products are unique in that they not just contain multivitamins and sodium fluoride being really sort of the base mineral that is really needed by virtue of the fact that they need this fluoride supplementation. But physicians often like to prescribe fluoride in combination with multiple vitamins A, B, C, and D. One of the B groups is a folic acid. But the reality is folic acids in the current form, in most cases, if you were to pick up an over-the-counter folic acid supplement, many patients, 40% or so, have an enzymatic deficiency that we really don't process folic acid very well to make it bioavailable and really usable by the body. So we have an ingredient called arcofolin that you mentioned that is a proprietary L-methylfolate. L-methylfolate is the usable form of folic acid that ultimately gets into the bloodstream and is used by the cells and ultimately yield its effect. And by the way, folic acid is used and recognized in the literature for a myriad of health benefits, inclusive of dental and gum health, inclusive of course, mental development and cognition, overall wellness, cellular health, and so forth and so on. So the benefits of L-methylfolate are well characterized, but very few patients realize they're actually not getting the benefit of that because folic acid does often not get metabolized. So we have an exclusive U.S. license to arcofolin, which is it's a license from Merck, European Merck, and we license it from one of their subsidiaries there. And it's got excellent clinical properties in that it's very pure. It's metabolized very effectively, and it's a patented trademarked ingredient that only Aytu BioPharma has access to in combination with the sodium fluoride. And so we've signed a long-term licensing agreement with Merck to that end and have exclusive access to this very novel ingredient that really does enable an improved dissolution profile of L-methylfolate, improved uptake, improved cellular response, improved purity. It also, by the way, extends our intellectual property runway fairly substantially, and we have a trademark license on top of licensing the patents that have been issued around the product. So good long runway with that, in excess of 15 years, and again, an exclusive agreement with that. But really, it's a superior sort of clinical profile to the other L-methylfolates and the other folic acids that are available. So we wrap that into an ingredient in a combination of various formulations. We have chewable tablet forms of our multivitamins. We have infant drops, so just liquid drops that you can drop on the tongue. And these supplements are they're growing tremendously for us. They've grown by virtue of, again, the expansion of awareness around the lack of fluoridation in some of these municipalities. They've also expanded by virtue of us really leveraging that RX Connect pharmacy platform and patient support program that we really put a lot of effort and thought into, and they've grown tremendously, as you've alluded to. Our pediatric lines grew 58% year over year, and so we're really poised to have those products play a meaningful role in terms of contribution to our revenue and to our bottom line.
You know, since you mentioned it again, why don't we just segue into RX or Aytu's RX Connect's operation? Could you talk about it in a little more detail? What is it? How does it fit into your marketing of the prescription medications? How does it help you differentiate Aytu from other pharmaceutical companies? And, you know, kind of take it from there.
Yeah, Aytu RX Connect is an in-house developed patient support program that in some ways people think of it as operating like a hub, but it actually works sort of in the inverse, in that we have brought on a network of over 1,000 pharmacies in the country that really serve as partners to us to help these patients get a better experience when being prescribed our branded medications. And we have, again, enlisted about 1,000 pharmacies to whom we recommend physicians prescribe our products. And for that, we tell these physicians, if you send it to one of our neighborhood pharmacies, your patients will get second to none service. We've vetted these pharmacies out. We work with them on a daily basis. We monitor their activity, and we understand really exactly what they need to do to ensure that that patient gets the lowest price available, while also maximizing the economics on our end. And so what it serves to do, and it, by the way, it also cuts out things like prior authorizations and step edits that are required, because these pharmacies are willing to go the extra mile and do more than some of the big box retail stores might do. They're really oriented towards serving the needs of niche products and branded pharmaceuticals. And these are independent pharmacies that want to do well by these patients. They want to do well by their manufacturing partners that they work with. And ultimately, they're incentivized to fill the best prescription for these patients. They're incentivized to fill brands because they recognize that that is the original brand. It gives the patients the benefit of the brand. And by the way, we fix the copays for these patients. And in a day and age when 40% plus of Americans are on high deductible plans and many times have to pay out of pocket for the full price of their drugs, we cut through all of that and enable patients to never have to pay more than $50, for example, for ADHD medicines. And that's irrespective of whether they've met their deductible or not. And so what Aytu RX Connect presents for patients and to physicians is predictability. Every single time they're going to be able to get it at the same pharmacy. First of all, they're actually going to be able to get it in the face of a shortage around the country. They're going to be able to get it at a pharmacy that they know and trust. It's often someone within their community that they know very well. And they're going to be able to get it at a price not to exceed $50 in the event that they're commercially insured. Very few, if any, manufacturers really have put such an aggressive offer in place. And we have said we're willing to put our money where our mouth is with RX Connect. In a day and age where people are experiencing higher and higher drug prices, it's time for people to get to a transparent single price that people can count on, as opposed to a coupon or a savings offer that a manufacturer might have that says you may pay as little as. We are one of the very few, if not the only, that actually, particularly in the ADHD category, that has you will pay no more than $50 if you have commercial insurance, because we'll rely on those claims for which we get paid and to enable us to potentially subsidize some of those prescriptions and on margin, make money on our prescriptions and our ADHD meds. And so it really works well to give certainty to the patient, take the hassle out of the physician's hands of having to worry about a callback from the pharmacy about lack of availability or not in stock, or it's a copay that's out of reach for the patient. It ultimately enables us to improve adherence, which obviously improves our refill rate, and it improves our margins. So everybody in the value chain wins. The patient wins, the physician wins, we win, and ultimately the pharmacies win as well, because they're gaining new patients, new customers, and ultimately we're supporting them to that end. So it works well. There's a lot of secret sauce that works kind of behind the scenes. That's by design, but it works, and we're able to monitor every prescription that gets filled and really make sure that we're constantly optimizing it for everybody in the value chain. And of course, that we're also being able to generate profitability on our prescriptions.
That's great. Thank you. part of your focus on your commercial operations has been to improve the operating margins through outsourcing the ADHD manufacturing to a third-party contract manufacturer. Could you give us a current status update on how that process is going? And what are your expectations for both the ADHD segment and overall corporate margins on a go-forward basis?
Yeah, we're making great progress on the transfer out of our Grand Prairie, Texas manufacturing facility. We announced when we acquired Neos Therapeutics over 2 years ago that we would pursue an outsourcing strategy as a way to improve margin. And we've made excellent progress. We've already received approval from the FDA to transition manufacturing of Adzenys, our amphetamine product. We received that clearance back in the spring of this year, and we've already begun transferring POs and starting production at the contract manufacturer. Cotempla is a bit behind that, but I'm happy to say that at the end of June, we submitted the application and everything that was needed in order for Cotempla to get reviewed by the FDA, such that we would expect a response, and we expect, by the way, an approval by year end or by early 24 calendar from the FDA to approve that application that enables us to move that production into the contract manufacturer. And so what this all nets out to mean is we will essentially be moving out of shutting down the Grand Prairie production and laying that team off, which, by the way, they're all aware of, and everyone knows the timeline and has been given sort of a full briefing of what to expect. That will all happen essentially by by the late spring into the early summer, and we'll then start to obviously manufacture in full at our contract manufacturer. It's important to note that we said early on that we would materially improve margins on these products by getting to a higher volume, more efficient contract manufacturer. The reason the margins have been so low is, frankly, we don't utilize the facility in full in Texas. It's a significantly underutilized facility, but you've got to take all of the direct and indirect costs, fixed and variables. Everything gets loaded into COGS. And if you've got square footage, for example, it's 77,000 square feet. We utilize approximately 25–30% of it. All the rest of that has to get amortized and baked into COGS. So it really has sort of artificially depressed the margins on those products for many years. Almost by definition, and not quite overnight, but it'll happen relatively quickly. Once we're totally out of Grand Prairie, we will improve margins materially. We said initially 15%. We're already actually relatively well on our way to sort of gaining those types of margins. We'll get further margin improvement once we're fully out of the facility. Again, probably this time next year, we'll be really starting to realize some of those significant margin effects. And so while we're not necessarily happy to be laying off a significant staff of people in Grand Prairie, Texas, what it will mean for our bottom line is material, and certainly it will enable us to drop cash straight to the bottom line. You couple that with the growth that we're expecting across our ADHD portfolio, and we expect to see significant margin expansion. So, and again, Roger, I would really draw investors' eyes to EBITDA and really our bottom line, as opposed to looking at top line, which again is going to be flattish to maybe slightly up on the basis of consumer winding down. Those ADHD meds will grow, and as they grow, and our margins grow, obviously EBITDA will come with that. And so this is going to net a very, very healthy outlook for the company as we get out of the facility.
Makes a lot of sense. And as you do that, I guess handoff, as you get both drugs approved by the FDA and shift to the contract manufacturer, how do you balance things? We talked about companies having dislocations in their operations. How do you balance it so you don't have any problems ongoing or any problems supplying product to your underlying patients?
Yeah, so right now already, for example, in the case of our amphetamine product at Adzenys, we're beginning to sort of balance manufacturing at both the Texas facility as well as the manufacturing at the CMO. And so we've got them producing some of our batches, in fact, beginning sort of now as we speak, while we're backfilling additional demand in Texas. And so while one is sort of winding down, we'll actually build up some inventory there, be able to have that stocked at our 3PL as the new manufacturer is building their supply as well. So there'll be a bit of noise when we look at margins here over the next several quarters. Which is why I said, again, sort of mid next year, we'll start to realize some of that. We won't begin to realize it in full until we've burned down all of the old inventory. So there will be a little bit of doubling up in some cases where we're making product in Texas, which obviously is going to be at the lower margin We'll also be building up supply in the manufacturing facility that we've aligned with here in the United States, the CMO here. So it will take some time. One thing that we will not do, and is we will not do anything to shoot ourselves in the foot such that we put ourselves at risk for stocking out. And so we'll build up supply here while we're building supply there, and ultimately enable us to continue to bridge the gap, which is this increasing demand due to all the factors that we've discussed, most notably the shortage. So it is a balancing act. We're not going to do anything that puts us in jeopardy of stocking out. So we'll have a little bit of noise from a margin perspective that will ultimately yield, we think, higher volumes, and then ultimately higher volumes with improved margins going forward.
Got it. But the bottom line is that people shouldn't be expecting that your margins are going to just take this big jump as we get to the beginning of the new calendar year, because you're doing this slow handoff to make sure that everything is secure. We'll call it on the inventory side.
That's right.
And it's really going to take 12 months to.
Yeah, I would think something in that range, and it's going to be a little bit noisy. And again, it's all dependent upon demand and how quickly we can get everything sort of dialed up at the new manufacturer, because it does take a little time to get them. They've got to get stocked with active pharmaceutical ingredient. They've got to obviously request the quota. Then they've got to make sure they have all of their processes lined up. But that's all working through right now. And so this is all to say, yeah, I would not expect a step function, for example, in the March quarter or maybe even the June quarter. It's going to take some time. This is a longer term view. This is something that will enable us to, really secure the long-term health of these brands. But yeah, over time, we will improve. It's just going to take a little while to sort of balance the wind down with the scale up. And, that's one of the key things we're working on every day to make sure that handoff is very smooth.
Got it. And in terms of all the good stuff that's going on here, and things like getting leverage out of the Aytu RX Connect, is there a place for, call it a strategic acquisition, to bring in additional drugs that could be put into the model and leveraged?
That's the great thing about RX Connect, Roger, is we've got the ability to do just that, bring in additional assets. It can be leveraged really through multiple ways. You can think about other ADHD meds. You can think about meds that sort of are in adjacent therapeutic categories that maybe, for example, psychiatrists treat, things like major depressive disorder. And you can identify assets that you could bring in and tuck in. And we're actively looking. Now, we're not looking for things that would take any meaningful cash off the balance sheet, but one of the deals that we did recently, we did a license on an ADHD med. It's a branded product. It's a category that generates about 16,000 prescriptions a week. And it's another form of methylphenidate. That's a prime example of the types of products that we could bring in. We'll be able to bring it in and reintroduce it as a brand, reintroduce it as the original, which many physicians in this category really value. Brands are important in ADHD just because the sensitivity around ADHD stimulants is such that many patients like to stay on the brand just because generics may not do the job for them. So we're excited about bringing that asset in. And I think that's just an example of the types of assets we can bring in to further leverage RX Connect. We're not going to go crazy. We're going to take it sort of step by step because, frankly, we have the assets in hand that we need today to drive, we think, meaningful profitability and continued growth. But as we have opportunities to tuck things in and align them into the RX Connect channel, we will certainly seek to do that. And we can do it again with meaningful leverage. We don't expect any need to bring in additional sales representatives or really any additional infrastructure. Any incremental cost would largely be really just cost of goods to secure the product from the manufacturer, and then any variable cost that would really result as increasing sales. So I think it's an opportunity to really, for the first time, see how this leverages with new products, not just the products that we've had in tow here for a couple of years.
You recently issued some equity. What did that raise do for you, and where does the, I guess, balance sheet allow you to go from here?
It really did solidify our balance sheet, I'd say once and for all, which is a really good feeling. And it also brought in a really strong institutional investor, really a couple, one of whom is very active in Nantahala Capital Partners, and to the point that they added Abhi Jain to our board of directors as their representative. So it brought in, a meaningful amount of capital that really gave us what we believe we need to operationalize the company all the way to profitability and cover all of our operating expenses. And it really, I think, leveled up in terms of our board. It really enables us to have a strong supporter of the company who is also very squarely looking out for the interests of shareholders and has already served a great purpose for us, and that they've really helped guide the company, really helped improve a lot of aspects of how we think about evaluating the business going forward. Really were instrumental in helping us further think through kind of the wind down of the consumer business, and as we further streamline expenses, and are excited to have Abhi on the board and have Nantahala in the cap table now as a significant shareholder. Being on the board, obviously, I think is clear demonstration to the shareholders that they're in this for the long haul with us, in this to help us really build the company the right way. And we're excited to have them on board. So not only did it solidify the balance sheet for the foreseeable future and really enable us to operationalize and cover our operating costs, it brought on a really solid partner for us as we build a foundation. And we brought in another institutional investor as well in Stone Pine, and they've been a great supporter, and we've been excited to interact with them and have them involved as well. So both have been great partners for us.
That's terrific. When we've talked about, especially since your year-end numbers were announced, a lot of very positive things that are going on. What excites you the most about where you sit, and more importantly, where the company is heading right now?
Yeah, I'm excited first and foremost, Roger, about the significant number of new patients we've been able to help with the ongoing shortage in ADHD, and frankly, with the growth of the pediatric products. We've been able to gather more and more patients and get them exposed to a system that actually works for them in Aytu RX Connect, and the ability for them to actually once and for all have some stability around availability of their meds, price of their meds, and be able to take one of those wild cards sort of out of their life. I'm excited about that. I'm very excited about just the financial condition of the company and really where we're going. Having posted the company's best quarter in history, particularly when you look at the prescription segment, having posted a 35% EBITDA margin on its highest sales quarter ever. We just continue to hit on all cylinders on that side of the business, and we're just excited to see it continue to grow. And again, top line growth is important. Really what people want to see, I think, and what we are driving towards is margin expansion, and to see that EBITDA turn into net income and cash flow. And that's ultimately, I think, what can unlock the most value for shareholders. And so I'm excited to see how that, I think people now have a clear line of sight to how that's going to happen. When you really should have block off the R&D spend and say, okay, drop that to the side, that's gone. Consumer health, drop that aside, and just focus on the RX segment. And we really, I think, did a decent job of elucidating this as we talked through our year-end results a couple of weeks ago. RX segment really is the company on a go-forward basis. And if you look at the health of that business, how it generated meaningful EBITDA really for the entire year, and then really strong EBITDA for that fourth quarter. And while we won't necessarily advertise and expect that level of EBITDA this coming quarter, I think people can see that we're starting to string together a series of really solid quarters for that segment, and it can very clearly stand alone. And I should point out, by the way, we really load our G&A into the RX segment. So it is appropriate for you when you're looking at that segment to really say, okay, that's the new Aytu. That's the business that will stand on its own going forward, inclusive of a public company cost, G&A, overhead, all those things. And so excited about just the performance and what we have in store. And secondarily, I'm excited about the leverage that we are going to be gaining and are getting through RX Connect, and the ability, as we spoke to a little earlier, to add in additional products at the appropriate time. That's not something we're going to do aggressively. And again, it's not something we'll do that burns any cash or takes any cash off the balance sheet. But you can see that as we start to expand the revenues and expand the product line through the addition of this new methylphenidate product, for example, I think we will have a clear view for exactly how leverageable that platform is. So I'm excited about what we can do with that. But most of all, really proud of the team, proud of really what we've put in place here over the last 12 to 18 months to get us into this position of really solid sustainability and growth. And think we can continue to execute and really build upon that.
Great. I think we are just about out of time, but have a couple more seconds. Anything else that might be helpful for investors to understand about the business?
I think I would just reiterate the fact that when you evaluate the company's business, whether it's evaluating our financial statements or evaluating some of our communications, inclusive of our press releases, to really hone in on that margin, to hone in on the prescription segments, specifically what we call the RX segment in most of our filings and most of our announcements, and really focus on how that is improving across the board. And I'll leave people with the fact that we haven't yet wrung all the expenses out of the business. With consumer coming down, sales and marketing expense will come down relatively materially. Again, margins are expected to improve with the transition of the ADHD products into a contract manufacturer. And we will actually see G&A tick down just a little bit here as we continue to sort of make efficiencies or build efficiencies within the operation. So just leave people with the fact that we're hoping and we're expecting this just to be the beginning of what is a nice growth story and a really nice margin expansion story with Aytu.
All right. Josh, thank you very much for taking the time to be with us today, and we really greatly appreciate it.
Thanks, Roger, for your time. Thanks for having us at the conference.
To anybody out there who's not already signed up for one-on-ones, again, please send an email to me, weiss@lythampartners.com, or again, visit our website, www.lythampartners.com/virtual, and click on the one-on-one meeting request button. And we hope you all enjoy the conference. Thank you again.